like this year, the market's up what? What's the market up this year? 20%? Clients guaranteed to make the 4.5%. They're up 20%. Now, if we were down 20%, they'd still be making a guaranteed rate.
Right. Yeah.
Okay. But the problem is you can't make more than the cap.
Yeah.
And so that's why I won't put a client in. And I know that's what my other client rolled their money into, something like this, because that's what they said they wanted.
Yeah.
And I told them I wouldn't do it. And I get paid well to do it.
Mm-hmm.
Really well. There's no break point. Here's why you get paid well in annuities over other investments. Is if a client puts $500,000 in a mutual fund with me, you hit break points where the commission that they pay is lower and lower, right? So it's like at most equity funds at $500,000 is 2%.
Yeah.
Okay. With annuities, there are no break points. So if a client invests $10,000 with me in a mutual fund, it's 5% or 5.5%, right? Well, if they put $1 million in it, or $500,000 in a variable annuity, I get paid the whole 5%, and there's no break points.
Yeah.
So the commission is just spectacular. They were selling like cotton. They were selling like crazy. Equitable was selling it like crazy. MetLife was selling it like crazy. They were so popular that magazines like Money Magazine, Fortune, all these different magazines were saying how great it was. But I knew all along it was crap. So the media was portraying it as a great thing to have. Of course, you can pull the wool over anybody's eyes, any journal size. So they just, it was, and the whole time I would sit down with clients. I can remember sitting down with clients in Cobb County, back when that's where I lived at the time, and they'd be getting these proposals from Prudential, and I tell them, hey, let me show you. The first year, 65% of the money you're putting in here is going to fees. And I show them all this, and they still put their money in. And nothing's changed. Okay, most of the people that are in this, and back when I was a stockbroker, I can remember all the brokerage firms I ever worked for. They would find the product that paid the best commission, and that would be what they'd recommend. So the main thing about most advisors is greed. Okay, whatever pays them the most, that's what they do. The recommendation I make to my client is not based on how much I'm going to get paid.
Right.
Let's talk about the difference between a variable annuity and a fixed index annuity. Let me tell you how my sales pitch on variable annuities. I would not put my own money in this. That's the first sentence.
You would not.
I would not put my own money. Probably $20 million of my client's money in variable annuities. But I have $160 million total. I mean, but so I do have some. But when I talked to them about it, I said I would not do this. But if you can't sleep at night worrying about your money, you want some kind of guarantee, then this is the best way to go. And I still tell them it's an expensive way. And first sentence I always say, anytime anybody is willing to give you any guarantee, you're paying for that guarantee.
Yeah, you're paying.
When a bank offers you a CD at 5%, and they've got all this stuff on guarantees on it, you're paying for that CD. You know that, right?
Yeah.
Because they're loaning out 8 to 10 times more money than what you deposit there. So if you put $100,000 in the bank, they're loaning $800,000 to someone to buy a house at 6.5% or 7%, and they're paying you 4%.
Yeah, they're getting a big cut.
Okay, so they're making. I always tell them that's why when you walk in the bank, they have marble floors, mahogany desks, and chandeliers in there. You're paying. There's fixed indexed annuity, and then there's variable annuities, which is what if I'm going to use an annuity, that's what I'm going to use. Okay. Here's why. Okay. With a variable annuity, if a client invests $100,000 with me, they're going to put their money in the S&P 5 in an Invesco S&P 500 fund. Okay. Now the Invesco S&P 500 fund, that mutual fund, for the last 20 years has averaged around 12%. Okay. And I tell my clients, if you put $100,000 in a variable annuity, after the fees and the guarantees and everything else, you're gonna make 10. So you're gonna give up 2% of your return to get a guarantee. And if that's all right to you, then that's fine. If you're still happy making 10 instead of 12, but you got a guarantee on it, then that's fine. With an indexed variable, fixed indexed annuity, well, any kind of indexed annuity, if you take $100,000 in there, then what they have is and you put this, you could have the same fund, an index S&P 500 index fund, okay, but it will have, like this example, but most of them aren't that low, will be like a 8% cap. So, like this year, when the market's up 20%, no matter what, you're going to make 8. Okay. On the variable annuity, historically, that fund has averaged 10%. But if you make, if the variable annuity, if it makes 20, you know, after the fees and everything, you're still going to make 18. Okay. You're still. What I like with the variable annuity, there's no down. You don't hinder my. Don't put your money where you can't make as much as you possibly can, or they're cutting you off on what you can make. And when you buy an index annuity, that's what you're buying. You're buying a limit on how much you can make per year. But it sounds good. How they present it is that we're going to pay you a guaranteed like 7.4%, like this one here. I think it's 7.4% on your withdrawals. Okay, well, our variable annuities have depending on what age you are, time you take money out, withdrawals, is 7%. Meaning, Corebridge has one that you guarantee, you know, most of the time when we tell our clients to take money out of their account, of mutual funds, I use 5% as a withdrawal rate, right? With these annuity companies, they'll set it up where you can take out, for example, 7% of the money of the income withdrawal what's it called? Guaranteed income. Guaranteed withdrawal amount, GWA. Guaranteed withdrawal amount. Yeah. So, like Corebridge account, the way it works here, let's say a client has 100 grand in there, and I put them in the Invesco S&P 500 fund. Okay, and let's say we put it in there today. And 5 years from now, you got two things going on. Okay, you got the guaranteed withdrawal amount, okay, and you have what's called the account balance. So one reason I like this variable annuity is it resets the most recent one. It's called the Polaris Daily Income Fund. And what it does is, let's say I have $100,000 in a day. The market goes up 5%. So my account goes up from 100 to 105, right? But then let's say tomorrow it goes down 8. It stays at 105.
Oh, it's still going to stay there.
It stays down. It stays at that high point. Okay, and then let's say a month or 2 months. But then one day it goes over the 105, it goes to 107. Well, then you get the 107. So it always resets. You always get the highest number, and it resets daily. Because the account balance, let's say it goes to 107, right? The next day it goes to 95. We get hit in the market. Okay. Your guaranteed withdrawal amount is still 107. But if you were to cash it in that day, you'd get 95. Account balance is one thing, guaranteed withdrawal amount is another. Yeah, you can't take more than guaranteed. And depending on your age, most times it's 6 or 7%, whatever. Yeah. Let's say 6%. So my client can take out 6% of the 107, and it's guaranteed that 107 will not go down. It will stay there, even if the market crashes. So the way it works is, let's say we have a horrendous market for a long time, okay, which we haven't had, but let's say it happened. And they withdraw, and they're taking their monthly checks off this to the point where this account goes to 0. But their guaranteed withdrawal amount is still 107, even though their account balance is 0, right? Okay. they will then get 3% of the 107, even though their account balance is zero. So they still get a guaranteed withdrawal.
So it's guaranteed lifetime income.
Exactly. No matter what, even if it goes zero.
Mm-hmm.
Yeah. But the problem I have with the fixed index annuities that
Right.
is completely, the markets don't work like that.
Yeah. Right.
Okay, you're going to have most of the time when you have a year like this year, when the market's going to be up 25% or 30%. Okay, generally you want to make as much. Like last year, the market was up quite a bit. Okay, 2023, the market was up 20 to 30%. Okay, then we had another year this year where it's going to be up over 20%. Okay, so you had 2 years in a row where you made 40, 50%. Right? Well, the odds are extremely high. Okay, that next year, 2025, you're going to be down to minus 30%. So what does that mean? It means that if you had a fixed index annuity for the last 2 years, you would have made 8. Missed out on that big jump cut. Next year, make 8.
Okay.
And then the next year, when it goes down by, you still made the 6 or 8. Oh, well, it's a lower number.
Yeah.
6%. Guaranteed or 7.4%. Okay? You would have made 7.4%. So you would have made 8 and 8, 16, 25.4% over 3 years, right? Instead, you would have made, with a variable annuity, you would have made 20, and we'll say, you could yield 2% for your return, 18, 18, 36, and then on the guaranteed withdrawal rate, you still get 7. So you would have made 43%, right? Because you're not cut off at the knees on the cap.
Right.
You still want to make 43%. But the fixed index annuity, you get usually less money. And you're paying for the same, you're paying the same amount. Here's the other thing. You're paying the same amount of money to buy the fixed index annuity as you would the variable annuity.
No, it seems like legislatures ought to make things like that illegal. You know, like universal life.
Oh, okay. Okay. Here's something that when I was bringing, when I was growing up as a kid, I know I think about dumb stuff. I think about weird stuff. Okay. I always remember Congress and the presidents and all that fighting over financial matters, right?
Yep.
And I always thought, well, how do they go from being a farmer or a whatever, or even a lawyer, to being an expert on finance?
Right.
They don't.
I don't.
They don't know what they're doing.
Mm-hmm.
Politicians don't know any more about money than they
I
do,
can't see them knowing anything.
than the average person, right?
Right.
So they're making decisions.
They're gonna be the best.
They're making all these financial decisions based
They
on
know nothing about it.
no knowledge.
They start their political career having less than $100,000, and they end at $100 million.
Yes. Yeah, they go in broke and come out rich.
Elizabeth Warren has passed some legislation
That is dangerous.
that she's done a lot of stuff, and she thinks she's passed it. Her rationale or a reason she passes this stuff or pushes for it to be changed is to protect the average consumer. That's her thing. And if you don't know anything about money, it sounds right. Right? If you don't know anything about money, that makes sense. Protect the consumer. Okay? But in reality, she's not protecting anybody. Matter of fact, she's costing more people more money. And it makes it harder and harder to become a financial advisor.
If you do a hypothetical, and say print off, it's 72 pages.
Yeah, I don't do that.
No.
So the bottom line is, people don't like to pretend they understand stuff when they really don't. If I really was doing what other people are doing, I should be making $700,000 a year, not $350,000 or $400,000. And enough class action lawsuits, enough other things that they were screwing the client so badly that it finally imploded. So that's why, remember when we were in the 90s, when you'd watch football games, NFL football games, you'd have the Prudential halftime report.
Yes.
That doesn't exist. Why? Because they imploded.
Yeah.
MetLife was Snoopy, was everywhere.
Everybody.
Okay?
Everybody remembers.
Everybody
that.
likes Snoopy.
Yeah.
They got screwed. They were selling a bunch of policies to a bunch of nurses down in Florida as investments. That came back to haunt them. Okay, so eventually they do get caught. Unfortunately, it takes 10 or 12 years for that to happen. Half of the high school graduates get 1/4 of some kind of financial education. that's why I like the variable annuities over the fixed indicate. But if I have a choice, like I said, if I have the same client that has $100,000 to put in a mutual fund, okay, and let's talk about, there's other reasons why it's not, okay. That same fund, that S&P 500 fund is going to average 12%, but I also don't like putting non-qualified money in an annuity. Because once you have non-qualified annuity in an annuity, you can't ever make it put it anywhere else.
Yeah, that's right.
Oh,
You're stuck.
you're stuck.
It has to go into another annuity, or you get tax penalized. Don't put non-qualified money, like somebody has a
Right.
CD
Right.
at the bank.
Yeah.
And they have $100,000 at the bank.
Yeah.
And it's not a retirement, it's not a retirement
Yeah.
CD, it's just regular. And you put it in a variable annuity, okay?
Yeah.
Immediately, now, that money is treated as if it's a retirement account, basically, the IRS.
Okay.
Okay? So, you can't ever go back to another non-qualified account with it. It has to be in another annuity.
Okay. What's the process called when you move from one annuity to another?
1035 exchange.
1035 exchange.
Yeah. If it's in a mutual fund, there's no guarantees, you're making the 12%, there's no guarantees, but it's also liquid. If the client wants to take 50 of it out, there's no charges and fees to do that.
Right.
But if you put your $100,000 in either one of these annuities here,
Yeah.
and you take $50,000 out, well, they're going to hit you with a surrender charge.
What's the surrender charge?
The maximum penalty is
Yeah.
6 months interest. But let's say somebody just put money in $360,000 in a CD, and it's going to be a 5-year CD. Okay, and the interest rate's 5%. Okay.
Mm-hmm.
So the maximum is 6 months interest, which is half of that,
Mm-hmm.
which would be 2.5%, right? I said, well, you're going to be charged $9,000 to take it out early,
Mm-hmm.
which is great, that's a lot of money, right?
Yeah.
Okay, or so if you take 360,000, that means you have 351,000 left after the charge, right?
Yeah.
But you have 4.5 more years for the money to grow between that CD, between now and the time the CD matures, right? You even after you pay the $9,000, in the 4.5 more years, if you average a 10% return, you're going to have 553,000. But after the 360,000 at 5%,
Yep.
for 5 years, you're still going to have $1 million less, $100,000 less.
Yeah.
So would you rather pay $9,000 and have $100,000 more, or keep what you got and have $100,000 less? Would you
Yeah.
rather have?
Yep.
So because the numbers tell the real story, right? And a lot of times I'll try to get. Oh, let me back up on that.
Yeah.
I'll ask them, how long have you been banking with that bank?
Mm-hmm.
40 years.
Yeah.
I know everybody over there. Well, I'll tell you, if you go up in there and ask them to waive that penalty, they'll do that too.
Yeah.
He wants to know, at the end of the day, am I going to have more money in my pocket
With
if I
CD
cash
on-
in the CD now or wait 5 years,
Yeah.
4.5 years? And the answer is cash CD in that.
Mm-hmm.
Okay, and take a $9,000 hit.
Yeah.
Okay, and then you have to explain to the client, the bank's going to say, hey, you're fixing to take a $9,000 hit. And if you don't do that, then the client's going to go to the bank, try to catch the CD, and they're going to tell them that. They're going to say 9,000, they say, oh, no, and decide they don't want to do it.
Yeah.
Always explain the worst case scenario on the front end.
Yeah.
What gets people in trouble is they don't tell them all the bad news, they only tell them the good news.
Okay,
I explain all my clients the bad news.
on the front end, so you
On
tell
the
them
front
up
end.
front. Okay,
Because if you don't, then they think you're lying to them, you're not telling them something they need to know.
yes.
Under promise and over deliver.
That said you always double the time you think the patient's going to take your drug. If you think they're going to be better in 2 weeks, you tell them it's going to take it.
The market goes up 13.41%. Your credited rate was 4.5%. So you get your $100,000 worth of $104,500, right? The next year, the market makes 29.6%. You get 4.5% again. Okay? It makes 11.39%. Oh, you get 4.5% again. Okay. But then the next year, the market goes down 0.73%. You get 0. This is even worse than I thought it was. Normally, the 4.5%, you still get that, right?
Down
No. a negative year, you go to 0. Because it shows again here, 9.54, you get 4.5, 19.4, 4.5, 6.24, 0. The guarantees you can't lose your money.
Oh, but guaranteeing that you're gonna make money.
Uh-huh.
Wow, that's kind of
Timex, you know Timex charges?
80%.
25% a month.
Right.
A month.
A month.
300% a year.
But-
Here, they showed over the course of 2 years, the market went up 46.96%. You only made 9.25.
Yeah.
Zero the year before, you still get your 100 grand. Now, once you annuitize it,
Yeah.
okay, you're right.
Right.
Okay, so let's walk down that road. This is good for Michelle too. I understand that what he just said was a good point. Let's say he has this client has 100,000 a year, and they annuitize it, single life annuity, and the single life annuity is going to pay him $1,000 a month. Okay, and 2 years after he's getting that $1,000 a month, he dies. How much money goes to his family?
Nothing.
Nothing.
Right.
But you chose the joint.
Yeah.
But now let's say you and Kim kill at the same time.
Same answer. Stop then.
Yeah.
They can't go on to the.
I've had some things happen to me in my first my lifetime that were challenging. I tell you what, I learned some good stuff. The key to life is when you have some screw up happen to you, learn as much as you can learn, so it never happens again.
Yeah.
And so you get others avoid the same pitfalls you got. They had a huge flaw in their underwriting process. Back when these policies were written in the 70s, so originally developed in the 70s, we didn't have a lot of the medical care that we have today. We didn't have a lot of medicines we have today. And a lot of the medicines we have today will keep you breathing. Okay. It may not improve your quality of life,
Yeah.
But it
but you're
keeps you
still
breathing.
breathing.
Yeah.
Okay, well, long-term care, that's the detriment of long-term care. Because the way long-term care used to work with all these medicines is if you had a stroke, let's say, and we didn't have the medicines we have today, 2-3 years you'd be dead.
Yeah.
Okay, not anymore. They got all these other drugs, blood thinners and all this other stuff. Now you can live 6 or 8 years. Well, those are 6 or 8 years more, those instead of 2 or 3 years of you not being able to get up from bed to a chair, do this. Now it's 6 to 8 years not being able to do that. That means you can be drawn off that long-term care
How
policy
much longer?
for twice as much time. Well, those policies weren't written for that.
Oh,
And
they-
so now you get claims that last way longer than they were
Than
originally
what they
intended.
anticipated. Wow.
And so now you got a problem. So what happened, and they paid the claims, and they're good about paying their claims. The problem is the claims last too long. Like I got a client, I mentioned this before, I got a client that has bone cancer. She's had bone cancer, she's been a claim now on her long-term care policy for 4 years.
Well,
Okay.
bone cancer?
Bone- Right. It used to be 6 months, you're gone. All right. You're still here.
That's the same thing's wrong with pensions.
Yeah, that's
Yes,
that's what Social Security,
Yeah.
and that's what she's saying, saying is right. That's what's wrong with Social Security and pensions.
Yeah.
Because when Social Security was written in 1935, okay, the life expectancy, you weren't expected to live much past 65.
No.
That's true.
Okay, so now everyone makes past 65.
Yeah, that's right. And that's-
Okay, so they're having to pay a lot more people for a much longer period of time than never intended. Teacher pays, if you calculate how much money the teacher actually paid into it,
And what they
and
give
how much the
out.
state paid into it, and how much they pay out, it's way higher than they should. If they live 10 years, they're gonna take out way more than what they
What
put in.
they actually.
When I first came to Primerica, and I picked up clients' life insurance policy they had with another company, the first thing I would do is read what year actuarial tables they used for that policy. And a lot of them when I started in 91, so early 90s, the actuarial table they were using back then was 1980 mortality tables. So the mortality tables in 1980 figured you die and way sooner than you're supposed to.
In bond funds, and they have been underperforming over the last couple of decades.
Yeah, right.
And so that's one reason pensions have suffered so badly, and that's another reason.
Well, and that goes back into, then in 2008, what happened is then the government came up again, thinking they were solving the problem. Okay.
Making a problem.
Okay.
Every problem.
So then they,
Another problem.
so they made them double the amount of money that they had in reserve at the back of it. Okay. So if you double the amount of money you have making nothing, then you have to charge more for that product. You know how people make a lot of money by buying a stock that they bet is going to go up? There's way more money made by people betting a stock going down.
That's right.
Yeah.
So what he would do, and that's called short interest.
Short.
Short interest is you're shorting the stock to death. Okay. So what he did, he went through and he found a stock. I think it was AMC, but he found a stock that was just being shorted to death. And see, only wealthy people generally would go down that path of shorting stock to death.
That's right.
So what he started doing is he started putting out a podcast from his basement, how people need to start buying that stock. Well, when people start buying a stock that has huge amounts of short interest, it makes these people that have the short positions have to cover, okay, because they can buy their leverage. They can own 10 times more stock than they have money holding that stock. Okay, short interest. So he started he looked at a particular company and said, this stock is actually a really good stock. You should be buying it. So he started putting it out on the internet, and people were waitresses, truck drivers, and cab drivers, and stuff, putting their $100, $1,000, or tip money, buying small amounts of the stock with Robinhood. And so they're buying these small positions, and it was so many of the small guys investing in this a little bit that it forced the big guys. They lost everything. That's called dumb money. The volatility index. You can make money off that.
Yeah.
And normally, when you see the VIX go up, right now it's typically sitting around what, 14?
It's 15.79.
Okay, so they're normally around 14, 15, whatever. So if we're at 15, and all of a sudden you see the VIX go to 24, wow, I can know without even looking at anything else, the stock market down.
That's right. Exactly.
VIX measures fear. It's fear index. Another way of saying volatility index.
Yeah.
It's fear. So if all of a sudden the market goes down 300 points, then the fear goes up, right? So does the VIX.
They were talking about that on Fox Business the other morning. They said when the investors are scary, I get greedy.
That's right. So if you're an investor, you can buy the VIX. You can buy the fear.
Yes, you can.
Yeah, you can buy the fear at 15 and sell it at 24.
There's always a way to make money.
Yeah.
And that's what I always tell my clients.
A way to make money.
There's always something making money.
Yeah.
And my job is to figure out what that's going to be. Now, I'll tell you what it's going to be right now. And I've mentioned this before. I'm telling you, you need to start slowly moving money from the floating rate fund to high yield corporates. I've already started doing a little bit of from floating rate to high yield corporates.
Well, what's making you think high yield corporates are going to come back strong like that? I mean, it's been a while.
Don't thinking about it. I know it's going to happen.
Well, tell me why.
Give it.
All right, but tell me why. What's the logic behind this?
Because the Fed's going to lower rates in September.
Yes, they are.
And they're going to lower them again in November. And they're going to lower them again in December. And they're going to lower them again in February.
And so businesses are going to feel free to start going.
Well,
they're going to make profits.
Remember, automatically, bond prices have been suppressed for so long. For 3-4 years now. Okay? There's no reason to own a bond. That's why right now when I come across a client that has a portfolio, and they have bonds in their portfolio, there's no reason to own this right now. And if I come across an advisor that has part of their client's money in bond, I'll say, there's no reason to be owning this. You're guaranteed not to make any money with this. And most clients and most advisors don't even know what a floating rate fund is. What's going to happen is rates are going to start to come down. When rates go down, bond prices go up. So you're not only going to make money from the higher yield, you're not going to make money from the yield you're making from the bonds. You're going to make money from the price of the bond going up, which would be a long-term capital gain, which is taxed at a lower rate than the interest income they would pay. All right, so historically, when interest rates come down, small cap companies do better. Okay, because they get to borrow money at a lower rate
Sure.
than they could before.
Sure.
And most of the motors, smaller companies are cash strapped. So small cap stocks will do better. Small cap
Value
stock-
and growth,
Huh?
value and growth.
Yeah, value especially. Small cap companies are cash strapped a lot of times.
So VSCAX is gonna be.
Yeah, but that's closed.
That's close, you can't do it high yet.
That's what you get, that's where I put.
Unless
my-
you're already
got
Yeah,
it.
yeah.
Yeah, if you're in it, you can.
Yeah,
Yeah.
but that's why I wanted, before I closed, I was chunking clients' money in it.
Yeah.
But VVOAX, which is a mid-cap bank,
Yeah.
is managed by the same people that manage the VSCAX.
Okay.
So that's an alternative.
Why did they close them?
Too much money.
Oh, it's too much money.
If you have a value stock fund, mid-cap value stock, there's only so many stocks that fit that criteria.
Oh, okay.
So you can only put so much money in.
And the same with the tax-free municipal fund that I like using, it closes from time to time.
ACSTX.
Oh, okay.
Yeah,
Yeah, but see, that one's been open because it's been
Correct.
losing money.
correct.
Okay, but that's why that one will do well.
Mhm.
That one, the share price will go up on that one too.
Yeah.
So high yield, bond, any kind of bond fund will go up.
Okay.
The reason I'm saying high yield is you can take advantage of higher dividend pays.
VVOAX is up to 28.68 year over
Nice,
year.
nice.
Yeah.
Eric, help me with something. People are worried about risk in investment. And whenever they talk about risk, they're always talking about volatility.
Right. But
But,
you can't separate the two.
but somebody used to say there's 5 kinds of risk. And they gave an acronym, it was LIVID, LIVID. And I don't remember all 5, but there's longevity risk, there's inflation risk, there's volatility risk, there's interest rate risk. And then there was one that began with D, and I don't remember what it is.
Diversification?
That could be, I don't know. That might be it. There's longevity risk, the risk that you were gonna outlive your money. There's interest rate.
Yeah.
Interest
Yeah,
rate.
we know that.
Okay.
Yeah,
You know how that goes. There's volatility, that's what everybody's scared of.
Okay, volatility.
But there's also inflation risk.
Okay,
You
inflation.
got to make enough to,
Stay ahead of it.
Which is hard to do.
Okay, that's gonna be on the tip. And what was the D?
I think the D is
I have to look that.
diversification maybe. That's not, because, you know, if you're in one thing, you're gonna,
Yeah.
so.
I own a bunch of American stock.
Okay.
It has done extremely well.
Mhm.
I sold some last week for $260 a share. I only sold the shares that were at least a year old.
Okay, very
At
good.
least
Okay,
a
and
year.
not a lot old.
Yeah.
So that, why would I do that? Why would I sell it?
Short term.
So I sold it because it's at least a year old. That means I'm gonna pay a long-term capital gain on it,
Okay.
not a short-term capital gain.
Okay.
Long-term capital gain is a lower tax rate than a short-term tax.
Yeah, you
And
would.
I'm taking that money, paying the least amount of tax, and taking that, putting it myself,
Okay.
so I can take a tax reduction from it. And because I also didn't want to have too much money in any one company.
That's right.
Delta went to zero.
You would have never gone, ever, not Delta, ever.
Yeah. I mean, you can think about a bunch of companies that went to zero.
We used to listen to a guy named Nick Murray, and Nick said, I have a deal with God. I don't make a killing, and I don't get killed.
That's right.
Don't be killing it, I don't
And
get you.
he divides his money into 5 pots, and, you know, he's got 20% in growth, and 20% value, 20% bonds, and this, and,
He's got it split up, nothing.
and at the end of every year, he sells off the one that's done best,
Oh,
down to 20%, and reinvests it so that everything is 20%.
We always used to say bears make money, which means you make money when the market, you can make money when the market goes down.
okay.
Wolves make money, as we make money as the market goes up, but pigs get slaughtered. You got so many different pieces of information that's intertwined with each other. You're having to try to read through all of it and see which part of the news will have the most impact on the market.
Okay.
Okay, here's an example. Raised me a cut down by 25 basis points in September. There was a whole world that knew that was coming for the last 2 months. So it's not an announcement that anyone that didn't know about.
Right.
Okay, so the market has already moved in that direction, thinking that was going to happen. The only thing that could actually happen is if they decided not to lower rates, then the market would get killed because they're getting something.
They,
You gotta remember, the market acts like a child.
Yeah.
And it throws a temper tantrum, it doesn't get what it wants.
That's exactly.
okay,
Which is what I like.
Yeah, if it doesn't get what it wants, it's gonna throw a temper tantrum.
Yeah.
okay.
So if they're expecting a quarter point cut and it gets 0,
Yeah.
then they're gonna throw a temper tantrum. The market's gonna sell off par.
Yeah.
Okay.
Oh,
Okay.
okay.
Or let's say they're expecting a quarter point drop and they get a half a point drop instead. They're gonna act like a child because they get an ice cream. So the market's gonna go through the roof. But the market always trades, and you gotta remember that the market always trades 6 months ahead
Yeah.
of what's actually where it actually is.
Yeah. Right.
The big money already knows what's happening way before it happens. That's why you gotta really pay attention to it.
So
That's
they
why
know.
that's why I'm talking about starting to buy bond funds right now,
Mhm.
because the floating rate pay fund is making 9% a year.
Mhm.
Dividend 9.6, I think, right now. Okay, you're making 9.6%, but they lower the rate a quarter of a point. Now you're making 9.35%. 9.35 instead of 9.6.
Mhm.
Well, what will happen is immediately though, people start taking the money out of bonds or loans or CDs and start to chunk it back into bonds. So bonds that were trading at, a bond originally trades at $1,000 a piece, right? Or a value of a bond is 1,000. But it looks like what? 100.
Yeah.
So they posted, there's a lot of confusing things about this.
Yeah.
Okay, so when you look at it, it says par value 100, what does that mean?
1,000.
1,000. They take a 0 off.
It's something,
Yeah, it's something.
in the Kennedy administration, that if the market suddenly takes a big tumble, that they have the right to close everything down, to shut it down.
But that already exists.
And-
That happened,
And the first time they
Nice
put it,
Yeah.
the first time they ever used it was the day Kennedy was assassinated.
Wow.
but
Wow.
there's what's called limit down,
Yeah.
okay? The market can only, if the market falls a certain percent,
Yeah, that's right. They had 9/11, yeah.
yeah, 9/11 happened.
Yeah.
If the market can only fall a certain percent within a certain amount of time, if it does, if it falls a certain percent in a certain amount of time, it shuts the market down for like 10 minutes.
Oh, okay, that's it all.
So it shuts everything, it's called limit down.
Limit down.
And one reason it does it that way is it gives everybody a breather to find out and decide what they're gonna do, and then they'll open it back up. And if it goes down, if it continues, it can go down like another 10%, it'll put the brakes on again. Pelosi is not worth $400 million, or there's a reason why she's worth $400 million. Okay, and her husband just so happens to trade stocks.
Oh,
Okay, she was the
Yeah.
Speaker of the House.
Yeah.
yeah, but God, that's still a lot.
And her husband, and see, they were trying to pass a law, that people in Congress could not own individual stocks,
Yeah, right.
which I thought was a good idea.
I still think it's a good idea.
Yeah, they won't pass it. They won't pass that law.
No, they won't.
Whatever, you're fixing to buy 1,000 planes from Lockheed. Don't you think that person should not be allowed to buy Lockheed stock?
You're not allowed.
No,
Absolutely
Not.
But they can,
They do.
Yep,
and they do.
because they write
but
the.
that's,
That last, Senate Majority Leader, Harry Reid,
Yeah.
Oh,
he came out of Nevada.
Yeah,
That guy never, ever had a job in his life except in Congress.
right.
never worked anywhere.
And retired $100 million. Well,
In Nevada.
he had a
I hate it here.
public servant salary, $140,000 a year.
Well, I mean,
Most he ever earned in
The
one year
Obamas were
from
worth,
his
the
income.
Obamas were worth $1.4 million when they went in office.
Yeah, they came out very
Because of
wealthy.
her.
Yeah,
Because of
Right.
her.
It
Because
became,
of her.
Big Mike.
yeah, it was her money.
It was her money.
Yeah.
Because he
Yeah.
was nothing more than a less than average public.
well, the governor.
Employed individual.
When he became governor.
So
of
she
Arkansas,
was the one that had the money.
Oh, yeah, that's a good example.
Oh,
The
Lord.
Clintons,
Yeah.
okay, the Clintons were, they were nearly broke
Yeah,
when they get in office.
yeah.
And now they're worth huge amounts.
Same with
Jimmy Carter came home broke.
Well,
When they left the White House, they were broke.
Well, Jimmy
Really?
played, I mean, when he was running, I remember Howard Baker from Tennessee said, Jimmy Carter is every elected official's nightmare, unemployed millionaire. and he was, and from his peanut plant.
Well, that's exactly it.
But he put it all in a blind trust, and when
Yeah.
he came out of the White House 4 years later, they run it all into the ground.
Well, but we can see that,
You lost it all?
well, well,
And he was not a
Brother
Politician, no, he wasn't.
Brother Billy.
you know, there's lots of things I don't like about Jimmy Carter.
Yeah.
But he was not corrupt.
No, he was not.
Well,
No, he was not.
No, Harry, honest man.
Harry Truman is like that. Harry Truman, you talked about it.
Yeah, Harry didn't start. I mean, all he had when he left the White House was a military pension from World War
How
I.
about that?
They never had a pension for the president until about 6 years later.
Yeah.
They started paying him enough to live on. He survived by writing his memoirs.
Yeah, World War One. Harry Truman was actually a great man, especially during World War One. He was in charge of a battery. He had Coke bottle glasses. They tried to not let him get in the military, but he turned out to be a hero.
Yeah.
So, yeah, he's got a good story.
Well, the Democrats ran him for office as one of the few officers in the war his own men didn't try to shoot him.
Well, yeah, so in the Army, lieutenants get fragged all the time.
Oh, yeah. Well,
That's because they don't know how to handle ordnance, but that's another story.
the tallest book, Truman, about this thick. That's one of the best books you'll ever read.
That's why you have to pay attention to make decisions about a lot of this. It's not an exact science. No one knows.
No.
But what I try to do is I try to, like I tell my clients the other day, my objective is to keep you in the middle of the road.
Yeah.
Okay.
Yep.
You're never gonna make the most money, and you're also not gonna get killed.
Exactly.
Okay. I'm gonna try to run right down the middle of the road. Okay. You're not gonna make the year the market makes 106. You're not making 106. You'll make 50. Okay. But the year it goes down 106% or 100%, you're still gonna lose 30. Okay. I'm gonna keep you down the middle of the road.
Okay.
And so, because your clients are needing this money to retire, right? They can't keep, they want to make the big money, like they're hearing the president making. The problem with it is you're also there, those are the same people who get killed in a couple of years when things go the other direction.
Sure.
For example, NVIDIA and AI,
Oh, there you go.
okay?
Yeah, that's a popular name.
You know how much money the CEO of NVIDIA has taken out of his own stock and sold to in the last
How much?
year? Can't remember how much. It's been several. He's worth 110 billion. But he's taken out a lot of root. So if the president of the company is selling the stock,
Get rid of it.
there's a clue.
Oh, it's a clue. Okay.
Yeah, he's shoring up the company stock.
If I'm the president of Eric Hoffman Inc.
Uh-huh.
and I'm selling the shares as fast as I can sell them,
Uh-huh.
and taking the profit because the price is way up here, it's because I think the chances are it's going to be down here instead of one. Right.
Telltale sign.
Yeah. Big sign. That's how I help the client. I helped the client. A couple years ago, I had a client up in Blairsville, Georgia, and they own some 144 stock. Put that down in your notes, because that will be on this test. 144 stock,
Okay.
private placement stock.
Yeah.
Private placement stock. Okay.
Yeah.
They own some private placement stock in the bank up in Blairsville, Georgia, and they owned it for years and years. And he came back from World War II and bought it. Okay, he was a tail gunner, World War II. So, and I looked at I did a report. They owned a bunch of them. They had nearly all their money in this one bank stock. And I started reading the reports on it, and I started noticing that the president and the vice president of the bank were starting to sell their shares.
Oh.
And I said, look at this. The president and vice president are selling their shares. You need to sell your shares. And they did, and they put it somewhere else. And right after that, it went.
Oh, bottom crash.
They were so happy.
Whoa.
I caught it. Private placement, on the stock market, your stock exchange, right? There's always a buyer and a seller, right? If they put the price of Home Depot stock at $250 a share, that's the price that they're willing to buy it at. And that's also the price you can sell it at. Well, there's a slight difference, so I didn't ask, but anyway, it's the market. But on private placement stock, if you own 100 shares of XYZ Bank, say United Bank, or I don't know if they're private placement stock banks. Hey, you have a bank. A lot of times, most private placement stocks are bank stocks. before you can sell it, you have to tell the other shareholders that you have some that you want to sell. And they have to buy it from you. So if you can't find a buyer, you can't sell it.
People couldn't find somebody, or you couldn't find
Yeah,
somebody,
they couldn't find
they
somebody.
would have been stuck.
Yeah, well, at least, really what I was doing is sticking it to the other
Okay.
shareholders
That's right. Mm-hmm.
for my client's benefit.
I was gonna say, their problem's not your problem. The client's problems are your problem.